All right, welcome everyone to today's Sunday macro wrap up for Sunday, February 2nd. Man, seems like January was pretty long. That's because it was. It was actually almost 5 weeks, which is pretty abnormal. But now we're getting into the second month of 2025 already, and we'll go ahead and get right into it here. So, as always, we're going to leave this hour for this Sunday macro wrap up here. The first 30 minutes will be streamed. The last 30 to 45 minutes, the public stream will end and it'll go only for Macro Optics members to go over some charts as well as some ideas that I got. All right. So I don't know if you guys have ever played those Tony Hawk video games, but it's interesting that the way that when I look at this picture, I think of what the market is thinking the Fed is doing. Because as if you guys have never played this game before, as you are grinding down these rails, you have to balance it with that meter that's right above here. And if you go too far on the other side, then you wipe out and you crash. And so what the market is trying to do is as the Fed is grinding this, we can call this the soft landing rail. If it gets too far on one side or the other, then that could be trouble. And it would take away from the Fed's credibility of what they're trying to achieve, which is a soft landing, right? And so if it goes too far to the left, then, that would be a hard landing where you get deflation and negative GDP, where on the other side, you get hyperinflation and a too hot of an economy. And so what's happening right now is obviously the big news is the Trump tariffs, which we'll get into detail in a few moments. But when something is not, when we get data that is not at this equilibrium on this soft landing rail, that's where the markets get freaked out a bit. And so with these tariffs that are in place, the the overheated economy happens where inflation picks up, things get very expensive in the short run. And that's something that the market doesn't want. What it wants is it wants the Fed to achieve its soft landing by continuing to disinflate inflation. So disinflation is when the rate is still positive, but it's getting close to their 2% goal. And then they also never get negative GDP, meaning they avoid a recession and inflation comes back down. But with these new tariffs that are imposed, what the market is scared about is consumption and demand will fall off while inflation goes up. And that's something that is the opposite of what the market wants. And so you're leaning towards one of these ways a little bit too far. Not to say that's what's going to happen. That's just what the markets are attempting to price in at this very moment in time. And again, we'll get into everything that happened and go over the exact fact sheet directly from the White House here. But as always, with these Sunday macro wrap-ups, what I like to do is I like to go over some of the data highlights from last week and then look at what's going to happen this coming week during this first week of February here. So on Monday last week, it wasn't too crazy of a macro data dump, although it was, a decent amount of data. We continue to see more data that supports that there's a housing freeze. So prices remain elevated, demand remains really low, and there doesn't seem to be much budging happening in the housing sector in the United States, mainly because interest rates are not coming down. That's not really the large news, which we'll get into in a second here. But we also saw that the Chicago Fed National Activity Index remains negative, which this National Activity Index, it takes a look at both consumption as well as producers. And as you can see, it's pretty much been negative since the beginning of 2023. Normally, you don't see that until, it's leading up to a larger slowdown. Not to say it is, it has been improving over the past couple months, but it's just showing that the market and the real economy still isn't in a recovery phase yet. It's still in a negative phase. Consumer confidence reflects this as well. So a lot of the optimism from the election results pretty much faded with this conference board consumer confidence measure. So we saw it go right back down to just 5 points after it was 104 points in December. So that's more back to reality. That was something that we were talking about over the past couple weeks. Manufacturing new orders remains negative, as well as we're starting to see the service sector of the economy. So the United States, you can think of as a more service-based economy where the rule of thumb is, 80% services, 20% goods. And so when you start to see the services economy weaken, that is something that you have to pay attention to because that makes up the majority of the economy. But we're still getting some manufacturing data that is improving, like the Fed manufacturing index or the Richmond Fed manufacturing index, which makes up of these states in the east side of the United States, and that has just been getting less negative, which can be considered as improving. And then on Wednesday, we received that the trade deficit on goods, and this ties into the Trump tariffs, that had its largest deceleration, yeah, it's had the largest deceleration since March of 2022. So before that, it was just in March, but there was a large decline, which is what brought the entire GDP number down, and this is due to imports accelerating. And so when you take a look at the calculation for the GDP number, the net exports is exports minus imports. And so if imports are increasing, that takes away from the GDP number. And so this is what brought the estimate down from just the or 2 days prior or the day before actually it was 3.2%, and then it went all the way down to 2.3% because of imports accelerating, mostly because different industries in the United States were trying to get ahead of these Trump tariffs, because that was one of the things that Trump mentioned on the campaign trail in November, was that he was going to do these 25% tariffs on both Canada and Mexico. So this shouldn't be too much of a surprise. Maybe it's a little bit of a surprise for how soon Trump did it. I think that's what the market is really trying to factor in here. But that's what brought a large deceleration in the GDP number. And so you can see that reflected here, looking at the real GDP number for Q4 of 2024. It went from 3.1% to 2.3. Not as bad as Q1 of 2024, but it's still a deceleration nonetheless. And then we also saw that the annual rate for pending home sales declined, which makes sense because rates are higher than average or higher than what was previously thought. And then lastly, on Friday, we got personal consumption expenditures. So this is one of the Fed's preferred inflation gauges. Hold on one second. Let me fix the screen here. So this is one of the Fed's preferred inflation gauges. And as we saw from CPI, as well as just the other inflation measures that we take a look at, this has accelerated for 3 months in a row, which was already priced in. So the PCE number is pretty much a lagging confirmation. Now, getting into the juice. So as we know, President Trump imposed a 25% tariff on Canada, a 25% tariff on Mexico, and a 10% additional tariff on China. And these are goods imports. So keep in mind that you have both goods and services, but most of the services stays in the United States, and we import most of our goods. But when breaking it down, it is pretty interesting. So just to give you guys a little bit more of a context here, where is it? I was trying to see when he was saying that they were going to stop it. It's in somewhere over here. I can't find it, but I read it beforehand, and he's not giving. Okay, here we go. The tariff will remain in effect until such time as drugs, in particular fentanyl and other illegal aliens, stop the invasion of our country. So, the reason why I'm reading that is because he's not giving an exact date, and it's just dependent on all of the policies that he's enacting. And so it's unclear when these tariffs will be lifted. Now, what is a tariff? A tariff is essentially just a tax that a country imposes on imports. And this is specifically with goods. And as I mentioned before, goods, they don't make up too much of the total United States GDP. So looking at this chart here, this is a chart of the entire imports and goods. And then hold on one second. Oh no, this is imports and goods that the United States has from the entire world. And then in terms of imports versus GDP, that's only at 9.2%. So effectively, imports only make up about 9% of GDP, which is relatively small. Now, when taking a look at imports of goods from Canada as well as Mexico, adding just those two components of all imports that the United States takes in comparison to GDP, that's only 2.7%. So just to think about it for a second, because I know that there's a lot of news out there, let's just look at the numbers. These tariffs only affect the United States by not even 3% of total GDP. Now, that's still a lot, but it's not something that's going to send the US economy into a meltdown. So we have to keep that in mind. And then also, as well, when taking a look at the other side, so for all the goods and services that the United States exports to Canada as well as to Mexico, actually, let me back up here for one second. When it comes to the export side, so this is how much of the United States consumption makes up both Canada and Mexico's GDP. Well, if you go to the United States trade agreement website, you can pretty much see what this was for the past year. And what was interesting is that exports make up nearly 20% of Canada's entire GDP. And so what makes up a large portion for Canada makes up a very small amount by about 10x for the United States. As well as with Mexico, Mexico is even larger, which is at 32%. So exports just to the United States from Mexico make up 32% of their entire GDP. And so the total trade with the United States for Canada is around 32%, and then the total trade with Mexico is it's nearly half. So nearly half of Mexico's entire GDP is with trade with the United States. And so what's interesting is that as we see these other governments, so the Canadian Prime Minister as well as the President of Mexico, they retaliated saying, well, we're going to impose our own tariffs on United States imports. But as you can see, it only affects 2% of all of our goods. Now, there's obviously some of those things translate to the services sector, right? Because if you're getting higher food prices on things that we import from Mexico, and then I think the largest import that we take in from Canada is either crude oil, I believe, as well as natural gas. And so, obviously those particular sectors, we might see an increase in those prices. So if you go to the grocery store and get avocados, they might be a little bit higher. Or if you use natural gas or propane tanks, the price of that might be a little bit higher. But all in all, in terms of the entire market, these other countries imposing their tariffs on the United States, it's even going to hurt them even more. And so it's a battle of short term versus long term. Which one is going to win out? Obviously, the United States has an incredibly large advantage. And so this is just something that was not too much, that it wasn't intent, or it wasn't, the magnitude of it wasn't being priced into the market. And that's why you're seeing a little bit of a scare from prices like Bitcoin. And so the purpose of this is to just say that Canada and Mexico have more to lose with imposing their own tariffs than the United States, and it doesn't affect the United States as it does these countries. So we'll see what happens, and we'll see if this turns into a trade war, which in the short term does have pain on both U.S. and foreign consumers. And so we'll get to the charts here in a second, but that's pretty much the Spark Notes and more data-based version of the Trump tariff news. Taking a look at the Atlanta Fed's GDP now for Q1 of 2025, that was at 2.9%, so it's slightly higher than the most recent one. It's a little bit too early to tell, though. Pretty much, you want to start really paying attention to the GDP now metric from the Fed, from the Atlanta Fed around late February, early March, because that's when it'll get a little bit closer. Taking a look at the Cleveland Fed's forecast for inflation, we can see that the CPI number is slightly, or it's about going to be the same, which is an increase from before. So the previous estimate, which I don't have available, it was around 2.6%, and that jumped to 2.85, which if you round it to the just two decimal or just one decimal point, that's 2.9, which is the exact same as it was. So the market was anticipating that inflation was going to come down for the month of January, where it looks like it's going to remain flat, which is an increase from the expectations. And so you're seeing a negative reaction. When looking at target rate probabilities for Fed funds, we can see that right now there's an 88.5% chance that they continue their pause regime. So they're not going to be cutting according to the March 2025 Fed meeting for what's in place. Now, this could change if we see a large drop off in inflation, or possibly if there's a huge crater in GDP. But as we discussed, these tariffs aren't going to crater the United States economy, and yet has to be seen with the effects on inflation. So we're not seeing too much of a price change there. And I believe the first cut, okay, now the first cut, there's a more of a percent chance that they're going to cut in June, which beforehand it was July, and it has moved up. I think it was about 5 weeks ago or 4 weeks ago where the bond market was pricing in that the first cut was going to be in September, and that has moved up from July to now June. So the market is pricing in something here. And again, this has to do with both growth and inflation, depending on what happens. And that all goes back to how the Fed's grinding the soft landing rail. Just to go through some other checkpoints here, the Chicago Fed National Financial Conditions Index is at levels that are similar to the beginning of 2022, as well as late 2021. So financial conditions still remain pretty loose despite interest rates remaining higher. And what's interesting is that because the initial as well as continuing jobless claims have been improving, the labor market scares have pretty much faded altogether. So we had a large drop off in continuing claims, meaning people are finding jobs. So when you see continued claims drop off, that means that people who have been on unemployment for a while, they are now finding jobs. And then as well, we have a decent deceleration so far in the beginning of the year. The end of December is around 8.5% year over year, or now it's 1.4. So the employment metrics are improving, meaning the labor market is coming down from its tightness, but it's still pretty tight. And then just getting into some of the earnings last week, we had big tech, Apple, Microsoft, Meta, as well as Tesla. There was a little bit of a surprise from Tesla, even though it had a bump, and then Microsoft had a shock and had a large drop off as well. And then there was some implications with Apple because their iPhone sales dropped off. And if you looked at it in real terms over the past 2 years, it's actually negative, but it did have an acceleration in its service sales, like cloud services and things like that. Next week, so this week coming up, we have Google earnings as well as Amazon. So those are the other two mega cap tech stocks that are going to be providing earnings next week. Let me see what days those are. So that'll be on the 4th. So Google will be on the 4th, and then Amazon will be on the 6th. So that's Tuesday and Thursday, respectively. Taking a look at one of my favorite long-term indicators. So this is the OECD CLI Diffusion Index, which is a mouthful. But essentially what this takes a look at is the year over year and month over month change in this diffusion index, which takes a look at the economic data from all the other, major G7 countries around the globe. And so this is a global index. And what's interesting is that it does have a leading mechanism towards the S&P 500. And so when you start to see both the blue and the red start to decelerate at a faster pace, that typically front runs the top in the market. And as of right now, we've seen the month over month number decline, where the year over year number has still remained elevated, similar to what we saw back in July of 2021. And so, that put about 6 months towards the peak from when this signal happened versus the peak in January of 2022 for stocks. So, not to say that's going to happen not to say that's going to happen in the same way this time, but there's a lot of other analysts that are also suggesting that around summertime, things are going to be a little bit tough in the financial markets. And it's just interesting that this unrelated metric is also saying that as well. So I do think that there are going to be more headwinds this year for the stock market than there were over the past couple years. I don't think, as of right now, from the metrics that we're seeing, that we're going to have a full-blown recession, but I would not be surprised, and there's a high likelihood that the returns for the S&P 500 are not going to be the gangbuster returns that we've seen over the past couple years, which were very abnormal, right? So the long-term average of the S&P is about 10%, and we had both, I think it was 25% back to back almost. So those were outlier years. So I would not be surprised if we had a lower year. Now, what's interesting is that when taking a look at both bank credit and the M2 money supply, we see that the bank credit year-over-year rate of change pretty much peaked in November of 2024, and it's remained pretty stagnant. It's pretty similar to financial markets, right? So it's similar to how the S&P 500 has remained stagnant. And then when taking a look at M2, if we really, zoom in here, that also peaked at the beginning of December. Actually, it peaked in November, early November, and it's pretty much remained around 3% year over year for the past 3 months now, 2.5 months. And so it's not surprising that when you take a look at the S&P 500, that it's also remained a little bit stagnant. Equity markets are highly sensitive to money supply these days, flows, as well as bank credit. And so that's why we track those on this channel. And the reason why we're having a lot of this crazy volatility is solely because we are in a new regime. One of the things that I like to talk about a lot is this new temperamental era in the markets that we're now experiencing that we haven't been in for the past 30 years. And this is a chart here of the 10-year Treasury bond yield. And as you can see, look what happened after COVID. I'll blow this up a little bit. So the 10-year Treasury bond yield pretty much has been declining, meaning that financial conditions have been pretty much easing over the past 30 years. And now there's been a rapid acceleration. And so just by looking at bond yields, which again, this is what lending rates go off of for 30-year fixed mortgages, credit card interest rates, all those things. As you can see from the pandemic, this has been just accelerating very fast. And I don't see this slowing down anytime soon or coming back down to the levels that it was pre-pandemic. And so we are now in an era where the average inflation rate as well as the average interest rate are going to be much higher than we've experienced over the past, 15, 20 years. And that's typically the normal range. If you go back all the way in time to the 80s, 70s, and 60s, pretty much from the 2008 great financial crisis to the COVID pandemic, we have been getting too much used to low interest rates and low inflation. And so a lot of people were getting used to that as the norm, but that was really the outlier when you take a look over the past, 50 or 60 years of the stock market. And the reason why I'm sharing this is because this is just different. We're going to have to not rely so much on just buying and holding things, and we're going to have to rely more so on active managing our own portfolios in a way where we can limit downside and keep our purchasing power ahead of this higher than average inflation. And so I really think that, gone are the days of just, buying a stock, closing your eyes, throwing a dart at an ETF or a stock and just, all right, it's going to go up. I think you have to be way more strategic in this type of regime. And that's really what we're aiming to do here at Macro Optics. And so finally getting into the charts here, we had a very interesting month in the markets. The S&P 500, we just took a look at bank credit, and it's similar to what we saw here, right? So where did the S&P start to lose momentum? It was right around here, and pretty much this November 11th number, which is when we saw that stagnation in bank credit as well as M2. I mean, look at the stock market. It stopped going up the way that it was. And not to say that's the only reason, but it is a fundamental case for the reliance on bank credit as well as the supply of money. Oops, sorry about that. I need to change my screen for you guys. I mean, put a one in the chat if you guys can see the screen now. I think it's there. But yeah, so what I was mentioning is that it's not a surprise that we saw a stagnation in the S&P 500 as M2 and bank credit has also been stagnating. And just looking at the performance over the last month, the best performing sector is actually the healthcare sector. So taking a look at a chart of XLV, that had a large acceleration from where it troughed in mid-December. And ever since then, it's had a very large bounce to the point where it's now back to bullish trend. And for those who are members who are going to stick around after the call here, we're going to get into a couple of healthcare stocks that we're looking at. But also as well, the other top performer was the price of gold, which gold has historically, it does pretty well in stagflationary environments. So let me see if I can find it. Here we go. So yeah, similar, gold was one of the top performers in January. We also had the financial sector, so XLF. And then we also had communications, and those were pretty much the top ones, as well as materials. But really, healthcare, gold, financials, and communications were the best ones. And what's interesting is that those types of stocks have to do with services in the economy, not so much goods. And so when we go back to the Trump tariffs, what sectors are going to be very resilient are the ones that have been performing already, because they're more services based. They're not as much goods based. So, if you take a look at something like consumer staples, which does heavily rely on goods, look at this chart. It's a completely different chart that's bearish. So that is pretty much what I'm looking at here. We can just go through some of the other data points as well. We're seeing a large decline in net central bank liquidity as well. So this was mid January. It was around 6 trillion, and now it's at 5.85 trillion, which is about a $200 billion decrease in central bank liquidity, and it's near the low end of its historical from when it paused in June of 2022. The Fed is continuously running off assets on their balance sheet. There's no change there. That's QT. We've had a rise in the Treasury General account. I don't know why. I was anticipating that this was going to start to decline because the RRP, which has been the greater source of a lot of this liquidity, that's had a large jump. And I marked this $100 billion mark for the RRP because that's really where it's stalled out, and it hasn't had a chance to get below that to supply further liquidity in the markets. And so at the same time that all this is going on with fiscal, we're also seeing a decline in net central bank liquidity. As you guys can tell, when it comes to the markets, there's different things happening this year than there were the last couple years. Not to say that, things are going to be doom and gloom. I've just pointed out three sectors that could perform or that and currently are performing well in this environment. So don't just say I'm being bearish here. Now, the volatility index of the S&P could spike on that, which it looks like it's doing now. 10-year U.S. government bond yields remain in bullish trend. And if this does form a higher low here and continues to accelerate, that would put even more pressure on what's currently happening. And then what's interesting as well is that look what the dollar just did on this Trump tariff announcement. That's huge. That's an enormous move for the dollar. Conversely, looking at the Canadian dollar, yeah, not so great. Not so great. So this environment, high interest rates, high dollar, high inflation, you got to be strategic. It's not just a buy and hold scenario here. And so I wouldn't be surprised if we, see a dip in a lot of the major tech sectors tomorrow, and then continuation for gold prices. Let's talk about Bitcoin. So for the people who are wondering, when Bitcoin is going to diverge from risk assets and US equities, doesn't seem like that's happening anytime soon, as it almost has a similar chart to Nvidia. But Bitcoin and digital assets are on the far end of the risk on the far end of the risk spectrum, excuse me. And so when there's ample liquidity, when there's a lot of risk taking, when people have money flowing over, they go farther out on that risk curve. And so it's not a surprise that what we've been talking about, Bitcoin has severely slowed down in terms of its momentum from where it was, at the beginning of October. And so going back to that notorious November 15th date that we saw from bank credit, look what it's done. It's pretty much remained flat, even though it's had, large ups and downs. This double top here at around 106K. And so not to say that I am bearish on Bitcoin. It's lost a ton of momentum. It's still technically bullish in our model, but I'm not jumping into this. And so taking a look at what I've been talking about for a while, which is stablecoin dominance. Stablecoin dominance is you just put in a new local high. So as you can see, since the beginning of December, stablecoin dominance, which you can think of as people running to safety, has formed higher highs and higher lows. The last time that we saw this was back in March of 2024, which was the last top in Bitcoin. And when Bitcoin dominant or when stablecoin dominance had this run up, that's when you had a lot of trouble in the markets. And then when we just had that rally, what did stablecoin dominance do? It dropped off. People are getting out of stables and going into crypto. Now the opposite is happening. So just looking at stablecoin dominance, that in the crypto markets, people are going more risk off. Not to say that this can't turn around if something happens, but this was a trend that we identified at the beginning of January to stay cautious about when it made this move here. And then when taking a look at total DeFi dominance, so this is market dominance in cryptocurrencies for just DeFi tokens, that's in a clear bearish trend. And then when taking a look at the altcoin dominance, so this is the total cryptocurrency dominance, excluding the top 10 cryptocurrencies. So you can think of this as altcoin dominance. That has dropped off as well. And we are at new lows. We haven't really seen it be this low since June of 2023. So definitely not altcoin season. There are a select few that are performing well. XRP had a pretty decent drop off. It still technically remains on a bullish trend, but um, yeah, that's a large down candle there. Hopefully, people are taking profits in this area, but that's pretty much what I have. That's pretty much what I have for you guys right here. If you guys are joining us live on Instagram, TikTok, or YouTube, what we're going to do now is transition over into just the members only for a Q&A session. If you guys are interested in joining that, you can just go to the link below or the link in my bio for our school group where you could gain access to these weekly calls as well as some other resources in order to further help you learn more about this macro environment that we just talked about, this more temperamental period in the markets. And so you can learn more about our school community there. But that's it for our live stream for the Sunday Macro Wrap Up. Good luck out there, and we will catch you guys next week. For those who are still on the call here, one moment while I just take it off. Okay. Bring it back to the charts here. Perfect. All right. Can you guys see my screen here?
Yes.
All right. Perfect. Perfect. Awesome. So before we get into some of the charts here, what are your guys' thoughts? And I'd like to have this as an open discussion on the presentation on the Trump tariff implications, as well as, what we're seeing with the market setup.
It was good.
Yeah, that was solid.
Informational.
Yeah.
Yeah.
Yeah, good deal, Johnny.
Yeah. Being Canadian, I'm a little bit freaked out right now.
Yeah, exactly.
I can imagine. And I'm sorry that this is happening. I'm sure it's not the best thing, especially in the short term, because I mean, it's unfortunate because we're the ones that have to pay the prices for all this stuff. So
Yeah. That's all good. But hopefully we can take advantage for the stock market right now.
yeah, I mean, luckily, the trends that we've identified that are in a bullish trend, communications, discretionary, although discretionary, you have to be a little bit careful because that could have a negative impact from tariffs. Energy, we took down to neutral trend, actually. And then financials remain bullish. 1 second. Healthcare. And I just saw that Aaron joined. So he can help me out. And industrial remains bullish as well. So 1, 2, 3, 4, 5. 5 out of 11 sectors are, still have opportunities. Ken, I said energy went from bullish to neutral because this was a pretty large drop. energy has been definitely a challenge for trading. Um, this is something where we've been tracking the price of oil, as well as some of our select, um,
Natural gas.
yeah, natural gas. Thank you very much. As well as some of our other energy stocks as well, and ETFs. But oil is still remaining in bullish trend, and as you can see here, when looking at the price of oil, the you have to look at it as, let's say the price of oil goes up, then that's not being counted in until the next CPI print, which then gets reported in the following month. So an acceleration in US oil that happened in January will contribute to the February CPI print, which doesn't get reported until the second week in March. And so to forecast more of what the February number is going to be, that would be January, or that would be what happened in December. And correct me if I'm wrong, Aaron, um, but taking a look at what oil was doing in December, it wasn't much of a move there, so it wouldn't be too much of a contribution, correct?
Um, it accelerated. It accelerated December, January. I, I'm not in front of my screen right now, but I think the number jumps from 74 on average, which is what it was, slightly above 74 for the month of January, to like 78 in February and 81 in March, in order to continue accelerating. So right now, the price where it is, it's under that average for February. If it were to stay at this level, that would that would start taking away from
Gotcha.
CPI.
Gotcha. Okay. Yeah. So we'll continue to monitor oil, but it still it remains in bullish trend. And then, yeah, so when taking a look at healthcare, that was the best performer in January. And obviously, things like healthcare utilities, those are more defensive, but it is interesting how the markets have have an early signal to different things that we don't find out about until the news actually comes out. And so when taking a look at some of the best performers within the healthcare sector, you look at a chart of CVS, which also has a decent, I think the dividend is about 4%. Let me see here. 4.7% is the trailing 12 month. Something like that, if you're looking to look for one of these things that are in bullish trend to buy dips, that would be one that I'm looking at. What else here? I think that's pretty much the biggest one for healthcare. I know that another one might be BSX.
CVS is a short, but not pressing it, Johnny.
Okay. I'd probably buy it, but
Johnson considered a healthcare?
what's that?
Is Johnson and Johnson considered healthcare?
Um, I think so, yeah.
Yes.
This doesn't have as great as trend strength as others, though.
The largest market cap out of anything in there, because they're one of the biggest companies.
Right. Yeah, that's true. Yeah, some of the better performing financial sector stocks. Fannie Mae had a big jump. Robinhood was one of the big ones. That remains in a clear bullish trend. I know that as far as consumer discretionary, we have been long Chewy. and that remains actionable. Let me see what else here. Looking at my list.
I think it'll be interesting to see how Chewy plays out because I have two dogs and I order from Chewy a lot, and theirs tends to come from China. So it'll be interesting to see how this happens.
That is interesting. Yeah, I mean, it's still signaling bullish trend, but that could change.
I
mean,
mean,
it's-
I think I've been on the call for a little bit, and I just hear all the stuff about the tariffs. I mean, again, it really doesn't matter as long as whatever the market's signaling, right? That's what matters. And
Yep.
like if people were worried about tariffs, that stock would have sold off already. Like I mean, that stuff gets priced in the market well before it's announced, just because somebody always knows something, and that's why we always just do what the market's doing, because most almost 90% of the time the market's going to be ahead of everything that you find out tomorrow. And if you just kind of do what the market's doing, then you take a lot of the risk off the table of being on the wrong side of some like big announcement where people are capitulating and selling and selling all at the same time, because you know the before that happens, the trend is likely broken bearish. It's pretty unlikely that, I mean, I don't want to say it's unlikely, but oftentimes these trends crack before they fully break. And during that window of time, that's like your window of time to start exiting once you see the trend starting to crack. It's really rare that you just get like a flash crash on some of these equity assets, right? It's usually, it happens slowly, then it happens all at once. So that's why I wouldn't overthink. That's all. The tariffs are obviously the big headline. I like to, and this is just me, like I like to just keep things simple, focus on what are the macro conditions. Okay, well, I mean, it's growth is kind of up in the air, and inflation is a lot easier to say. Well, we're probably going to have more inflation. So, okay, what do you do with that information? Well, you own what's going to work when inflation is accelerating. And, that's generally been, which we've been on the right side of, large cap growth, momentum types of factors, right? So that's like like ARKW would be an example of growth. XLG would be an example of large cap, right? For momentum, that's SPMO, which we've had as well. So, those are the factors that have been performing the best. And it's you cut through the noise and just focus on what are the trends, where's inflation headed, where's growth headed, and try to get a probable macro condition set and focus on the trends and the assets that will perform well in those environments, regardless of whatever the news is. So that's just my 2 cents on from what I've heard so far from being on this call.
Yep, good stuff, Aaron. Yeah, we had mentioned that, the market is a discounting mechanism, and so it's pretty interesting how you can see some of the moves happen before some of this news comes out. And so, like Aaron said, somebody always knows something. And I mean, you can clearly,
That's why we pay attention to volume, because when you see things breaking trend on volume, that's because people know something, and then usually you get like a little bounce from whatever capitulation just happened. That's where you can usually get out, or ideally you get out before before something breaks on volume. That's why when something goes neutral, you stop buying it or just get rid of it altogether, because that means something's changing. And if it breaks, usually it's going to break in a big way, because it's gonna break trend on volume all at once. And then that but sometimes in subsequent days, if you see certain levels starting to break on volume, that's going to indicate that it's going to keep, you need to watch, because if it keeps breaking levels on more and more volume, that's just more selling, building and building, and it's more likely to break trend. So, I mean, that's really why we always emphasize looking at the volume of something because that usually tells you the significance of the move. It also tells you, who may or may not know something. I mean, that's just the reality of the situation. I mean, it's illegal, but people trade on insider trading or insider information. So you have to, respect that and use just under, you have to understand the game and use that to your advantage. And so that's what I'd say on that.
Yeah, well said. I mean, it's unfortunate, but it is reality. So, uh, as much as we hate to know that there's just these, mega buyers and sellers that are doing insider trading based off of their own, insider knowledge, it's something where they might be strategic whenever they do it, but if you pay attention to the different math metrics that we track, then those are just things that you have to pay attention to. And so, um, that's why we prioritize the math and the trend on the charts over fundamentals and the macro data. Not saying that those things aren't important, but when you have the trend on the charts being supported by both the fundamentals and the macro, that's typically the best type of environment, if you're long or short, depending. So those are the types of setups that we look for. And then when, like Aaron said, when you start to see a change and, things that were making money aren't making money anymore, that's typically where, you want to start to be cautious on things or just look for things that are in more of a bullish trend. And so, Aaron, in terms of the different, sectors that are bullish here, what is your, oh, one thing I forgot to bring up was,
Here, you can look at TPYP as an example because that's one where I, rem- I'm trying to get better about, you know, timing of some of these removals and additions. It's difficult sometimes because when you have winners, understanding when to take them off is, you know, is more difficult. So with this one, I looked at it. You had KMI as well, which we've been long. KMI is one of the largest holdings in this ETF, and so I'm looking at this and I see a break break trend on really big volume on the same day that you had all the semi stuff going on. So, what then in my mind, I'm thinking, okay, so has this thing just been on this huge run because it's been correlated with the performance of tech and semis? And so, I don't know that, but maybe that's what's been going on. And you get a trend break on volume on the same day that you had Nvidia and Avgo break trend as well.
yeah, look at
And
that.
that's the biggest holding in TPYP. So I sold KMI outright, on the bounce. Don't capitulate and freak out with everybody else, but get a 2-day bounce, get rid of it. And then on TPYP, right? That's a very similar ETF to AMLP. Uh, I mean, when we first put TPYP into our allocation, I think it had like a 7% dividend yield, and it went up so much now the dividend's like, I mean, now the dividend's like 3 or 4. AMLP still has a 7% dividend yield, has better trend strength, it has a larger weighting with MPLX, which we're also long.
So three.
And, so we're still long a similar type of exposure. We're long AMLP, we're long MPLX, but, kind of reducing some of the exposure to that area by just removing one of them that lost some trend strength, relatively speaking. So, you know, that's that's a recent move that we made. But you look at something that breaks trend on volume like that. That's an example of what I'm talking about. When you see that, you if you get an exit point, because sometimes you rarely get second chances, you take it, and then yeah, I mean that's a decision. You have to live with it, and you just kind of move on to the next thing. And if it could prove to be the right decision over time, or it could not be. But ultimately, there's always going to be another opportunity. So.
That's right. Opportunities are like the city bus. There's always one coming around the corner. Yeah, I mean, would
Uh,
you
quick,
say, oh, go ahead, sorry.
So speaking of the trends, I was wondering, would you be able to pinpoint exactly kind of how you look at what is a bearish, what is a bullish trend, and then more specifically, the Russell 2000, right, seems to have this like up and down, up and down, up and down, like big stuff going on. Like how would you read that and say what is trend is that in?
Yeah, good question. So the way that we look at it, first off, is by looking at the math, right? So in terms of price action versus volume and volatility performance, where does that put, where it's at its current point? These are all different indicators that I've used in order to give a forward-looking expression of those math metrics that we look at. So these aren't the nominal numbers, but when taking a look at some of this, specifically with small caps, you could see that this recent red move on Friday, you had volume accelerating into that, while net cumulative buy volume is about to turn into sell volume. And then you had a little bit of an increase in 30-day volatility. And if you guys are like, what the heck is this guy talking about? This is all covered in the course modules, as well as we have the PDF document where you can add all these to your trading view and how to use them. But it's essentially a combination of all these different things and in relation to what the current macro is doing. And so, just looking at what's happening here, you have accelerating volume on red days. Losing momentum and volatility is still higher than where it was, even back in July. And so that is something that is just showing that it's more of a neutral trend than something else that's in a clear bullish trend. So looking at this from a 1 week, 1 month, and 3 month performance basis, you can see that, it's negative on that 3 month, as well as almost 1% down on the week as well. And it hasn't been forming a series of higher lows or higher highs. It formed a lower high right here, as well as a lower low on January 13th. And so from where it peaked out in late November, the price action is bearish. You're having accelerating volume on red. Cumulative volume is declining, and you have historical volatility increasing. And then in terms of the macro scenario, if small caps typically do the best when there's ample central bank liquidity, growth is accelerating, inflation is accelerating. As of right now, growth has been stagnant and decelerated actually in Q4 of 2024. So you have low to stagnant growth. You have, inflation reaccelerating. It's not, I mean, small caps could perform well, but they've obviously been struggling. They don't perform the best in that environment. So it's all those factors being taken into consideration. But Aaron, did you have anything to add to that?
Um, I mean, I think, my response, I would say come to Macro Madness on Tuesday and we'll spend 20 minutes talking about it. Just because I can follow up more in more detail. I think you're running this until 8, so or maybe not, you can let me know, but I can add more value on Tuesday on this topic.
Gotcha. I mean, it's covered as well in the course material, so I would just reference chapters 11 and 12 for you to review that there. But
I would say with the Russell, I don't look at trend lines like Johnny has on his chart. Um, but something like the Russell, it's best, its best performance comes when growth and inflation are accelerating. We had a window of that in January, and it sold off thereafter. We were long some of the small caps and kind of got, and I was, we were definitely on the wrong side of that VIX spike that went to like 80, or the largest one-day move in the VIX in history, and that definitely impacted some of the positions that we had on at that time. Well, when some things start to change like that, okay, let's think about what's happening in a macro environment as well. You have gold starting to make new all-time highs again, broke the bullish trend maybe 2 weeks ago. You have Bitcoin dominance starting to make higher highs and continue to trend higher. So what is that all that telling me? So gold does really well when growth is slowing, inflation is accelerating, or when growth is slowing and inflation is decelerating. So, I mean, what does that mean from a probabilistic standpoint? We think inflation is more likely to accelerate than decelerate. So, I mean, just taking a signal from gold, that means that that might be indicating more of a stagflationary condition set. Additionally, the same thing with Bitcoin dominance. You look at something like Bitcoin dominance as an indicator telling you that, okay, that's, large cap factor, the market's favoring Bitcoin over these other altcoins, which in the digital asset space, that, I mean, those are essentially the equivalent of small caps, right? And so you see large cap Bitcoin starting to outperform and eat away market share of some of these altcoins. So then you start seeing that divergence. Well, that's a condition set that we've been observing under, when you have more of a stagflationary environment. So, you kind of put the whole mosaic together, and then that tells you, okay, so the Russell 2000's kind of neutral. It's just chopping around, and that's in part probably because the Russell 2000's one of the, it performs poorly under stagflationary condition sets, and it performs poorly when growth and inflation are both decelerating at the same time. So, you know, that's kind of the signal that I take on that, maybe at least on an immediate term basis, whether it's just this month or on, well, I mean, I guess it'll be to be determined if it's going to be on a trending basis, but that's probably part of the reason why the Russell 2000 is kind of in limbo mode, because it doesn't perform well under stagflationary conditions. So you take the context of what the trend's actually doing, which right now it's below its trend on 3-month momentum, and then you take the context of what's happening from a macro standpoint, which is, there are signals for more of a stagflationary condition set, at least on an intermediate term basis. And that's, to me right now, you could see the Russell break either way, but having it as neutral means I'm not going to, it's just kind of like a wait and watch thing. I'm not going to own it. I'm not going to, I'm not going to short it. Just kind of just see how it plays out, because if there's better opportunities out there and there's better assets that are performing the Russell, why would I take a shot on something that, could, break trend on me, right? And if that happens, I don't want to own the Russell. And, I'd rather have that money in something else.
So I guess my question wasn't so much targeted on like exactly what the Russell, investing in the Russell, but more along the lines of like, it's a good example to, I wanted to use it as an example of how would you classify that as bearish, neutral, or bullish, because it looks like a good example to, because of all the choppiness that it's been doing. So how would you look at that? Make sense whether it's neutral, bullish, or bearish, by all of that up and down motion. It's not so much exactly that I want to invest in the Russell, but just the price action. How would you how would you classify it more?
Well, I mean, the first thing that I noticed is that it broke. It, I mean, it broke its trend initially on huge volume, right? And then the second thing that I'm noticing is that it's still below its 3-month momentum line, and so from that standpoint, it's bearish trend. However, you look at RVX, something like RVX, and Johnny, can you pull up a chart of RVX? That's what you would look at to look at the volatility of the Russell. That's not it. Sorry, I'm in my car right now. And so from a volatility standpoint, I mean the Russell vol while it's I mean it's around 21, so it's like it's in more of a choppy zone, but it's not like a it's not the it's it's not in a bullish trend itself. But when Russell volatility is within like the 20 to 30 range, it's just gonna be a little bit more choppy, usually. But I'm more focused on the recent trend break on volume and the fact that it's below its 3-month momentum. If you're looking at specifically at the rate of change of the price, today's price is lower than what it was a little bit like less than 3 months ago.
So you would kind of look at that as it is right now and just say it has bearish trend. Is that correct?
I mean, I'd say I mean, I would just say it's more, I mean, I call it neutral because I'm just like not, because if it was bearish, then I'd be looking to short it. I mean, I mean, you could call it, call it neutral or bearish. In my mind, neutral because I'm not doing anything with it.
Got it. So I guess what I'm kind of deducing here is maybe there's no particular exact set of parameters to decide whether or not it is bearish, neutral, or bullish. It's kind of opened up to a little bit of interpretation. But I mean, I can see it too. I can see how it could be neutral as well. It kind of really hasn't gone anywhere in several months. So I would look at it, just looking at it without knowing anything else about, its volume or its momentums. And if I would look at it, I would just say I would say neutral. But is that sort of a correct hypothesis on? It's kind of more open to interpretation a little bit.
Uh, I mean, I'd say no because I mean, this is based off of a rule. I mean, it's for me, it's a rules-based process, and I have, you know, what I just mentioned that I look at that tells me, okay, bearish, neutral, or bullish. However, at the end of the day, we can all define that the whole purpose of what we're trying to help everyone do here is create their own rules-based process, right? Everyone can utilize the tools that make the most sense for them. You know, what we provide is a framework of how, how we look at that. And if that is, you know, if there's something else that works better for you, then by all means utilize that as part of your process. What's important is having a repeatable rules-based process that you follow. And over time, that consistency, assuming that you're using the correct components to build that model, you, that's, that's where we want to get everyone. For me, it is like it's is there are specific factors in that, and that's how I've made my decision. There is a level I will say there is a level of subjectivity because if I mean you can when something breaks trend, you have the ability to say, okay, rather than just immediately taking this to bearish trend, you can give it a day or two. Because like right now, I would say that technically speaking, in my model, it would yes, bearish trend. However, I'm just calling it neutral because like from the volatility component, which is another component of what we look at, that's not rising the way that it normally would within a bearish trend. However, there's multiple factors. I mentioned the macro condition set, I've mentioned the volume, I mentioned the price movement. Those would indicate that it's a bearish trend. So, from that standpoint, just calling it neutral, not doing anything with it is more of, me just like just waiting and watching altogether on everything. But, when something is neutral, that's a zone in between bullish and bearish where it's more of just you're just waiting and watching, not doing anything with it. From the standpoint of like a a trend transition, right? Because if something is going from bullish to bearish, right, the stop in between would be neutral. Sometimes you get, there are movements that can be, outliers, and you have to be able to filter out the noise even within your own model to say, okay, is this material? Like, was this actually a material trend break, or is the price going to get back up above trend within the next, couple of days? And if I sell it right here, am I, you know, am I going to be just caught up like in whatever kind of outlier move that this was, right? And so you have to be able to, that's where it gets tricky to filter out that noise, right? Because you have to be able to discern between what is actually transitioning from whether it's from bullish to bearish or bearish to bullish. And in between that zone, you often see something kind of losing its volatility a little bit, which is a sign that something might be changing. And when the volatility breaks out alongside with whatever direction it's going in, that's the direction that the trend picks. But I hope that helps somewhat. And we can talk about this more on Macro Madness on Tuesday.
Yeah, your explanation it does help a lot. Yeah, so there's a lot of things to look at. And like there is that like small touch of subjectivity, like you said. But I think I get it. I understand where you're coming from, and yeah, it does help. I get it.
Yeah, so David, it's mainly, looking at the 1 week, 1 month, and 3 month performance, as well as the price action. Has it broken structure and is it making a series of higher lows or higher highs? And then in relation to that, where's the current price at? So, obviously on this move here, on this big volume day where I had this drawdown, that was a break in its bullish structure. And so from there, a few days later, it did even go below that, and then it just had like a pop up on, from January 10th to January 21st. And so, if it was to continue going lower from here back to where it was, that would constitute it being in a bearish trend. So it would have to reclaim trend and keep going up from here to, get bullish again, essentially. And you would look at that as, okay, is it reclaiming its bullish trend on higher volume as well as, is volatility dropping off and, volume increasing with it, as well as it's becoming positive on a usually when something is switching, it'll be positive on 1 week, 1 month, and then 3 month going backwards. So there is some subjectivity based off of, where you want to label it in terms of like your portfolio goals. But in terms of determining if it's like bullish or bearish, these are the tools that we use. And you can find these tools for your TradingView. If you go to my profile on TradingView, you can just download these.
Cool. Thanks, Johnny. Thanks, Aaron.
Yeah, great questions there. So I know that we're a little bit over, but that question did take up a decent amount of time. So I wanted to see if anybody else had any other questions before we wrap up here. And it can be about anything. I know that we have some new people on the call as well. For those who are newer, I would just go to back into after this call, just go back into the community and let me switch my screen here and just go to this classroom tab to where it says start here.
Sounds good, Johnny. I'll ask you how about that Glass F that you're following? You heard a little speculation about. Any news on that or what?
No, I mean, cannabis stocks haven't really gone anywhere. And yeah, this one in particular, you know, it's one thing where, we do like the team, but as you can see in our model, it's in a bearish trend. So that doesn't mean that I'm like holding it in my portfolio. It just means that yes, it's something that we would like to own given the circumstances. So it's on the list. But as of right now, it's in a bearish trend, so you don't want to hold it as it's in bearish trend. Um,
Fair enough.
but it is something that we do like the team and think it has a fundamental case. But with a very small company like this, you have to exercise caution there.
Fair enough. Sounds good.
Yeah, I tried to take a little bit of a shot on Solana unsuccessfully, but it's okay. It was a small amount. All right. Well, if there's no more questions there, we can wrap it up unless someone else has any last minute questions or if something comes up after the fact too, you can just go into the community and ask your question there. And then, yeah, appreciate everyone for joining this week, and we will catch you next Sunday.
Awesome. Thanks, Johnny.
Thank you, Johnny.
All right, everyone.
Thanks, Aaron.
Good
Have a
luck
great
out
night.
there. Bye bye.
Too.